Good morning, everybody from North America. Good afternoon to everybody in Europe and South Africa. My name is Danny Callow, and I am the Chief Executive Officer of African Gold Group. And I'd like to welcome you to this webinar where we talk about company updates and answer some of the questions that have been sent through via mail as per the invite. So I'd just like to point you to the disclaimer on our presentation, which will be available on the website after this webinar. So I hope that there are a number of people joining the call that have been following the progress of African Gold Group over the past 19 months or so since we've been involved. I also hope that there are some new people joining the webinar for the first time. But I'd like to take you through a few slides of where we are, where we're going, and where we hope to get to. So we believe that African Gold Group has highly attractive investment fundamentals. We've produced a definitive feasibility study in July of last year that showed 100,000 ounce average gold annual production for the first 5 years of the life. This turns into more than $400 million in pre-tax cash flows over the life of mine. The project itself is fully permitted and ready to build, and we're really one of only a handful of West African developers that have a mining license and are ready to construct. In addition, the definitive feasibility study showed a very compelling NPV and IRR of 284 million and 45%. We believe that we're in a very low to medium security risk area in Mali. We're situated in the southwestern part, around 4 kilometers from the Guinea border, but with very good transport and logistics links into the capital Bamako. In terms of our share price upside, we have Canaccord initiated research on us in around September last year with a target price of 79 cents. You can see that there's significant upside from our current share price to our target price. We've also done a very good job in cleaning up the balance sheet and the payables register, and we're debt and royalty free, so we're unencumbered, and certainly that makes it very attractive when we look to put together financing packages going forwards. We also believe that we can bring first gold forward by a number of months to what you would typically see in a project of this size, and from start of construction we can deliver first gold in 19 months. And I think for me, what is really important and what we've really been focusing on very hard over the last 19 months is to really start to understand the future potential of this deposit. And we believe that we have a multi-million ounce gold reserve potential here. And later on in the presentation, I'll talk to you a little bit about some of the results that we're starting to see coming out of that drilling program that we have been busy with. And we've certainly done a lot of work in trying to select a management team that has the capability to take this through construction into operation, and also a board that has done this before and has the right mix of skills to do the same thing. So we have moved the board around. We've got a very experienced board now. Our chairman, Scott Eldridge, has a background in financing. Jan-Erik Bakkers, vice chairman based out of London, and a good access to the London markets, has a very good financial background, but also a lot of experience in the mining sector. We have veteran John Begerman on the board. John is a mining professional. He's currently a director of Yamana Gold, but he's also been involved in taking projects like this through the development phase into construction and operation. And Pierre Pettigrew is a diplomat effectively and a politician, and spent a lot of time as foreign affairs minister in the Canadian government, and is a very good advisor on international public relations. You will also see that we have a new chief financial officer, Paul Bozoki. We'd like to welcome him to the team, and a new company secretary as well. And that is all part and parcel of the separation from Forbes and Manhattan that was finalized on the 31st of March of this year. So we'll talk a bit about that, but Paul joined as Chief Financial Officer, and Sean Drake joined as Company Secretary, and that really was the culmination of our relationship with Forbes and Manhattan. And we are now a fully independent company and have no consulting agreements or links or contracts with Forbes and Manhattan. Just to have a look at the capital structure, we have 179.8 million shares outstanding. Our market cap is a little bit higher than that today. It's around 28 million Canadian. We have seen a significant move from the institutional side in becoming involved in our stock, which is really good news for us. So we are seeing a good balance now between, I guess, retail and institutional investors. We have seen a good uptake in institutions coming in the last two private placement raises, and that number's moved from around about 8% 19 months ago to 32% today. And in the bottom left of the screen here, you can see that we are getting very good support from some of our larger shareholders, and hopefully they will continue to give us support as we move forwards into future financing and construction. I think for me that the tone of this presentation is really about delivering on promises. All too often junior miners get lost in the fog, and they don't really take a step back and have a look at where we were and where we're going. So I think what I'd like to do is just take you through a few bullet points here on what we've been saying we're going to do and where we are on that progress. So from 19 months ago, we did a very thorough review of all the technical data that was in the data room that we inherited. There was a substantial amount of drilling on this property, around 130,000 meters. That's quite sizable for a junior miner. And the information was fairly scattered and hadn't really been analyzed properly. So we spent a lot of time sorting through that. We set up additional drilling campaigns. We've in fact drilled around about 18,000 meters in the last 19 months. And what we've seen is a sizable increase in the mineral reserve from around 500,000 ounces to 755,000 ounces, and a strike length increase in terms of future targets by up to 80%. So when we inherited this project, or when we joined the project, we had strike length of around 30 kilometers. We now believe we have more than 55 kilometers of possible mineralized strike on the property. And this really talks to this huge upside potential that I think everybody knows is there, but we're now starting to really hone in and get a good handle on what we're dealing with. At the same time, there was a feasibility study in place back in 2019. We weren't too happy with it, so we made a decision to do a full suite of metallurgical testing. That fed into the new definitive feasibility study. And what that did was it settled us on a very straightforward West African gravity plus CIL plant, giving us around 96% recovery and a leach time that is pretty fast for this type of deposit in around 12 to 15 hours. So I think we delivered on that. All of this obviously rolled up into a definitive feasibility study, and that was delivered in June of last year. And as I mentioned, some fairly compelling NPV and IRR numbers here, and that was done at $1,530 gold. So we still really have some upside in terms of the current gold price. And even if we have a look at the long-term gold price, we do believe that there is some substantial upside in the NPV and the IRR going forward. Late last year, early this year, we have spent some time testing the sulfide potential of this property. So again, to put this into perspective, we have a very sizable oxide resource that makes up the definitive feasibility study. Within the feasibility study, the sulfides weren't touched. We knew we had around 345,000 ounces of measured and indicated sulfides. So we made a decision in January of this year to go out and test those to see how they behaved. And I'm very, very pleased to say that they are free milling, which means they're non-refractory. That's probably the best you can get. And I think even more compelling for us is that we're getting recoveries of around 96% of our sulfides through the existing designed gravity plus CIL circuit. So what that means is that we will be able to pull some of our sulfides into our overall reserve model now when we update it later this year, and hopefully see an uptick and be able to treat those through the existing circuit. We've also done a fair amount of exploration and infill drilling. I think from the beginning, from the first webinar when I spoke here, I talked consistently about this sizable resource potential. We haven't changed that story. We believe it's massive. We found a new shear zone in the Gosso target. We drilled around 750 meters of that and defined a good mineralized continuous strike. And we also expect that potentially to be upwards of 8 to 9 kilometers. And then through a very, very aggressive process in the start of this year, we had a look at our corporate governance, we had a look at our corporate structures, and we set about changing that substantially by appointing some new directors and making the board more independent. But at the same time, we also severed our relationship with Forbes and Manhattan through the termination of an office services agreement and all of the consulting agreements that came with that. And what that's allowed us to do is drop our corporate costs by around 70,000 Canadian dollars a month. So that's a sizable reduction. And that allows us to be a little bit leaner and meaner going into the next few months. Just to give you a recap on the highlights of the definitive feasibility study, as I mentioned, pre-project cash flows of 400 plus million, 100,000 ounces of annual average production, 10 years of targeted mine life, very compelling all-in sustaining cost numbers of $782 an ounce. And that's certainly down in the first quartile or the lower quartile of most of our peers in this region. 755,000 ounces of proven and probable reserves coming from around 1.2 million ounces of measured and indicated resources. And ultimately, we have this very sizable, easy to target inferred oxide resource at 1.1 million ounces that's sitting very close to surface. If we have a look at the numbers here on the base case that was done at 1530 gold, that's what gives us this 284 million, and this is the yellow colored highlighted block. If you have a look at consensus long-term gold price, you can automatically see there's almost 100 million uptick in the pre-tax NPV and a 10% improvement in the IRRs. And if you have a look at current spot prices there or thereabouts, you can see that number jumps another 40 to 50 million. So as I mentioned earlier on, we do have some substantial upside in terms of the gold price that we used in the study. And obviously, when we go and update the technical report later this year, we will review consensus and spot prices and rerun the models at potentially a higher price. The project itself is pretty straightforward. So if you have a look at the diagram at the top, we have an open pit towards the top of the picture there, feeding into a jaw crusher, a mill section, and then into gravity plus CIL. It's very common in this part of the world. It's most definitely the most effective way and cost-effective way to treat oxides to get the best recoveries. And as you can see, the whole plant is very compact. I would point out that we always leave space for expansion here. So as we believe that we have significant resource and reserve upside, there is space to improve this plant in terms of a phase 2. So we've left space for an additional mill, we've left space for 3 more CIL tanks, an additional elution column, and another electrowinning train. So all of this fits into this nice footprint here, but certainly could be expanded bigger than 100,000 ounces as we carry on the current exploration program. I think some of the questions that we get from investors is around our grade. I think you've seen that companies working in this part of the world can operate at much lower grades than this. There's been some big successes with companies operating at 0.6, 0.7, 0.8 grams a ton. But just to put this into perspective a little bit more, grade is one input into a financial model, but there are a number of others that give us this very compelling $704 an ounce operating cost. And if we have a look at the top left of this slide, a couple of these I've highlighted. So the geology here is very straightforward. We have a dominant oxide ore body sitting on top. There's no sulfides mixed up in that. It's in what we call the saprolite, which is very soft and friable. So this is a free dig operation. So we don't have to blast. It's open pit. It's very easy. The stripping ratio is only 2.7 to 1 over the life of mine. So that means that we're not moving a whole lot of waste out the way to get to the ore body. On top of that, we've factored in and priced in a very stringent grade control program, which is necessary as you work in the lower grade deposits, but that will give us a very good opportunity to blend the right grade into the plant on the ROM pad. The other thing that a very soft rock does for you is it gives you a very low power requirement. So in this case, we're running at a bond work index of about 1.5 kilowatt hours per ton. That translates into less than 10 megawatts to run this plant. And coupled with that, as I've mentioned before, we've gone for a hybrid solar, battery, and thermal generator plant, which means that we can produce around 35 to 40% of our power from solar and battery storage, which substantially reduces our environmental footprint, but it also substantially reduces by about $6 million a year the diesel and the heavy fuel oil costs that we need to power this plant. So that, I guess, if you look at it in simple unit terms, it translates to about 15 cents per kilowatt hour versus 25 to 30 cents per kilowatt hour on a pure generator-driven power plant. On top of that, as I mentioned, the process is very straightforward, but we also have very good leaching characteristics. In fact, we leach around 96% of our gold within 16 hours. We have designed the plant to handle a longer residence time, which gives us a bit of flexibility on any variable stuff that comes through. But ultimately, that translates into much lower reagent use during the CIL process, specifically in the cyanide and the lime. And again, as I mentioned, if you have a look at our $782 all-in sustaining cost down here in the bottom right-hand corner of the slide, you can see that against our peers, we really are running down in the lower quartile of this as well. So I think, in summing up, that the DFS is a very robust, compelling study done by very credible independent experts, but delivering some really, really solid numbers for this project as we move forward. Just moving aside from the definitive study for a while and having a look at the progress on our exploration program. Now, most of you who have been keeping a track will have seen a number of press releases coming out over the past 3 or 4 months on progress on these programs. And I think it's safe to say that we are very, very happy with the results that we've received so far. We're very confident that those results will translate into improved reserves. But just to give you a highlight, we have 3 phases ongoing at the moment. Phase 3 being the Gosso target that I mentioned earlier, and that you can see that's highlighted where my mouse is here on the right-hand side. We have phase 4, which is effectively a very focused infill drilling program over the current resource shell, and the primary target here is to convert some of those inferred oxides that I spoke about earlier on. So there's about 575,000 oxides in here that with some infill drilling, we have a good opportunity to convert a large chunk into reserves. So clearly that is low-hanging fruit for us. And then in phase 5, it's really starting to test the extension and the continuity of some of these northeast, southwest shear zones that we have tracked and mapped all the way along, but we just need to put a drill into. So we believe that the infill drilling on the oxides, plus some conversion of the sulfides into M&I as well, will give us a very good opportunity to try and convert close to 1 million ounces of reserve as we update our resource and reserve statements over the course of the next few months. Again, just to talk Gosso for a minute, and why Gosso is quite important to us is that this is about 4 to 5 kilometers away from our current main shear zone where our open pit will be. And if you recall the diagram that I showed you, the plant sits inside between the 2 shear zones. So naturally, if we can develop this to be a second major pit contributing to the process plant, we don't have all the problems of trucking and moving material long stretches. So this is really quite important for us to start to develop that Gosso target. We had some very good results here, some 7 grams a ton over 1.3 meters, 1.15 grams a ton over 12.5 meters. And we're very confident that as we continue to drill this out, we will see the same sort of continuity that we've seen in the main shear, but we'll also see similar grades. So that's giving us confidence that all of this will be very economic and be able to be pushed through the process plant design. For us, I think what's been the biggest focus, and probably around about 90% of our drilling over the last 3 months, is this infill drilling within our current phase 4 resource shell, as we call it. Obviously there, what we're trying to do is close the gap up between drill holes to determine the continuity of the geological structures, to make sure that those shear zones are consistent throughout the area. And the area that we're really targeting is this northeastern part of the resource, where you can see most of the blue in this bottom corner here, and that is all inferred oxides that are very easily convertible into measured and indicated oxides. What we're seeing on this drilling are three key fundamental aspects. We're calling it thesis 1, 2, and 3. And what we're seeing in thesis 1 is large portions of the drill results conform to similar grades of the current inferred resources. So we are starting to see a slightly improved grade as we move to the north, and I think we've spoken about that in successive webinars. But we're getting the confidence now that that is possible from some of the drill results that are coming back. The second thesis that we're seeing is we're discovering new mineralized zones outside of our current geological model. So where our geological model was telling us it's waste, we're actually finding new mineralized zones, and that's very encouraging. So as we continue to drill, we will continue to test that and see whether we can see improved ounces. And the third thesis is that as we drill deeper into the sulfides, we're starting to see the oxide boundary being up to 60 meters deeper than we were expecting. And what that does is potentially pull more oxide ounces into our oxide model, and that can be treated through the process plant. And to talk about that, thesis 1, as we mentioned, was some good correlation in our geological model on grade from infill holes. So it's telling us that our model is good, it's got integrity, and we're very comfortable with that. Thesis 2 is this outside mineralized area outside of what we call the ore envelope, which is this. And you can see here, excuse me, that here you have around 34 meters at 1.17 grams a ton of grade that we didn't know existed before. So certainly as we start to drill this out through sections to the north, we will start to see hopefully some continuity here, and obviously there are future ounces that we can bring in. And then the third thesis, which was this gain or depth gain in the oxide sulfide boundary that I spoke about, that brings a whole lot of ounces here that we initially had put aside as possible sulfides, and in turning them into oxides. And one of the reasons for that is that, as you can see, these diagonal holes coming in here, these are some of the historical holes that were drilled in this deposit, and they were finished in the ore body. Our new holes have drilled right down, and they're starting to go into the sulfides down the bottom there, and this gap is effectively new ounces that we didn't know existed. So that's very, very good for us. And then I think the final part of this exploration program, which for me is probably the most exciting, that is this extension of the shear zone to the northeast. So again, put it into perspective, this is where our current resource pit shell is sitting. So this is where the current mine design is. Everything to the northeast in this shaded area is all mapped geologically with old artisanal workings and regional geological techniques, and we're very confident that there is continuity all the way through this. And at the moment, that could be a potentially an increase of up to 16 kilometers. So we're very excited to start putting some drills into here and testing the continuity. It's not something that will convert in the next 6 to 12 months into a measured and indicated, but it will certainly give us a very, very good fundamental understanding of what we're calling this multi-million ounce reserve possibility. I mentioned it, but I think we'll just clarify it. We did a very comprehensive sulfide metallurgical testing program. Initially, we just went out to test to see whether the sulfides were free milling, but consequently, we've gone and added a whole lot more test work to this. So we've done comminution testing, which shows a medium hardness rock, which is great news for us. It's not very, very hard. We're getting great recoveries through the gravity plus CIL process. We're now doing leach optimization tests. We're also doing what we call variability tests to make sure that we can handle anything that gets thrown at us from the sulfides across the ore body. And by the end of April, we hope that we will have a fully completed sulfide study done, which will roll up into an updated definitive feasibility study and technical report. Ultimately, what this means is that a portion of the 345,000 ounce measured and indicated sulfides will be convertible into reserves, as they'll be treatable through the same process plant that we've already designed. So that's really good news for us. On the financing side, I guess we're in the sort of same situation as many junior miners at this stage. We have an opportunity to continue to explore, and really, I think, just in terms of some of the results that we're seeing, and hopefully a good technical report upgrade a little bit later this year, we really do have an opportunity over the next 18 to 24 months to target probably up to 1.5 million ounces of reserve. And that really puts us into a strong position going forwards. On top of that, we also have the opportunity to continue our discussions with financiers to see whether we can start to construct this plant. We've always tried to run a parallel path here to make sure that we don't get stuck going down one path. We always said that we would continue to drill whilst we were trying to raise the money and build the plant. So we're not doing anything differently, but we are obviously bringing some convertible ounces forward into the reserve statement. And then the third investment path that is being followed, as you can imagine, at current market value versus the actual value of the project. We have a fair amount of interest in us from various corporates. This could take the form of a merger, it could take the form of a sale, or it could even take the form of us looking at an acquisition as well. So I think just for the benefit of this presentation, I can't say too much, but certainly we are not turning away any advances, and we will evaluate every single opportunity on its merit, and all of it must be geared towards being value accretive and improving shareholder value. So I think, just to summarize this slide, we can continue to explore, and we're very confident that every hole we put in the ground will give us more ounces of gold. I think to do that, we would have to continue to update the resource and the technical reports, and we could do that twice yearly. That would give us a continual sort of update to the market that we're moving in the right direction. We do have some discussions going on the main capital raise, and some of those are in relatively advanced stages in terms of due diligence. We haven't received any term sheets on that yet, but we're certainly going through the due diligence process. And as you can see, they're a mix of senior debt providers, hybrid debt providers, and a number of royalties and streamers. And then obviously, we have had a number of advances, as I mentioned, on the corporate side, and we will evaluate all of that. The board has set up a special committee to evaluate any offers that come in, and we will treat every single offer as a serious offer, but obviously always look at whether this is in the best interests of our shareholders. On the ESG side, again, I think we've spoken about this a lot, but I think that we certainly have always had the attitude that we do not want to be a massive environmental polluter. So we went down the route of the hybrid power plant. That reduces the emissions significantly. There's about, as I said, about 35 to 40% of our power will come from effectively green energy, and the balance will have to come from generators. On the social side, we've maintained all through the COVID pandemic very good relations with the local communities. We've had a small team working on site. Our COVID protocols have meant that we have not had one case of COVID, thankfully, and that has allowed us to continue working in the community. And certainly a lot of what we've been doing at the moment is fixing of roads, bridges, and malaria spraying, and making sure that we employ locally and get some wealth flowing back into the local communities. And so far, that's been very, very successful for us, and we have seen a real advancement in our relationships with the three main local villages. And then on the governance side, June of this year, for most of the gold producers out there, is the first requirement for submission to the European Union on the new Conflict Minerals Act. Clearly, we don't produce gold, so it's not important for us, but we have taken the step of engaging with SAFE Limited to assist us through that process when we start to design our supply chain to make sure that it conforms to that legislation. Again, on the social side, I think I've spoken about most of this. Health and safety, we've had a very good run, and we've had no incidences on site through all of the drilling and the construction around the camp that is happening. We've also had some fairly stringent COVID protocols, which has allowed, the government has allowed us to continue working through the pandemic. It has been challenging to get in and out of the country, but the team that we have on site is very competent to do that. And then just to wrap it up from my side, as I mentioned, we're only one of a handful of construction-ready projects. Once we start construction, we can deliver first gold in 19 months. We have a very robust DFS, good pre-tax IRRs and NPVs, with an opportunity to produce 100,000 ounces a year at some very compelling all-in sustaining cost numbers of $782 an ounce. I think, as you've seen, in terms of the valuations, we have huge share price potential upside, and whether you look at it from a share price perspective or from a dollars per ounce of resources and reserves in the ground, we're very undervalued to our peers. We believe there's some significant upside potential still in this company. We have an experienced team. We've built mines before in Africa, greenfields and brownfields. We have a board that's experienced in talking to financiers and raising that financial money. And we have a full team on standby to come in and build this project once we're ready to go. I think on the resources side, we've shown from the beginning that our target here is to prove the upside potential of the resources. We have done that so far, so we've seen a big increase in the reserves by close to 50% in the last 19 months. We would expect to see another increase over the course of the next few months. But at the same time, we've gone out regionally and we've really started to understand some of our adjacent exploration concessions. Ultimately, then we've seen this massive 55-kilometer identification of shear zones, of which 51 kilometers has not even had a drill poked into it yet. And I think from a board perspective, with change out of the board and some of the corporate changes that I talked about, we now have a clear strategy for growing this company through construction, obviously, and then funding organic growth and disciplined M&A as we move into becoming a free cash flow generator. So that's my presentation. We had actually received a few questions from investors before the call, so I think I'll just go through a couple of these and then see if there's any other questions before I finish. So I think that the first question was around the separation from Forbes Manhattan. The investor wanted to know that Stan and his affiliate companies have nothing to do or implement on running the business or any decision making in the company. I think that I've made that quite clear, but just to reiterate that, we have absolutely no agreements whatsoever with Forbes and Manhattan or any Forbes and Manhattan employees. All of those contracts were terminated in January, and the last payments of that were done in March of this year. So we are now a fully independent company with a new company secretary and a new CFO. So I think from that perspective, that's very good news. Another question that came in was around Pierre Lalande, who was a former chief geo for AGG, predicted almost a decade ago that the main zone at Kobada was a 5 million ounce resource. This potential seems to only recently have been discovered by new management. I guess I beg to differ on that. I think we've always seen the massive upside potential in this project. We've spoken about it from August of 2019. We've done about 18,000 meters of drilling on this project to close up the drill spacing. We've reviewed all of the regional geological data again, and that's where we've seen this big uptake in shear zones. And obviously at the same time, we've also delivered about 48% more reserve ounces, which has allowed us to move this project to a 100,000 ounce project. And then I think the third question that came through was, what options are the company looking at with regards to corporate activity? I think I mentioned that in the financing slide, but the simple answer is that we take every approach to the company seriously. We have a special committee made up of the independent directors of the board who will review and analyze any formal offer that comes into the company. Clearly, those offers have to be value accretive for our shareholders. And certainly, I think that If we got to the stage where a serious offer came in, then we would obviously have to go out and talk to people about that. But we certainly have a fiduciary duty to make sure that we seriously look at every approach that comes in. I've seen a couple of questions coming up on the chat, and I'm just assuming that I've still got some time here. The analyst target price is asking, is it from Canaccord UK? Could we expect some Canadian analysts covering the stock? I think Canaccord is a global company, so although it came out of Canaccord UK, it was a Canaccord global research piece, so it came through from inputs from the Canadian, Australian, and London team. I think the analyst sits in London anyway. I think that you will start to see some additional research coming out on this stock over the course of the next 2 to 3 months as well. A second question came in that the company has enough reserves to produce 100,000 ounces for 7 years, and once production starts, the cash flow can continue to explore. That's 100% right. We always intended to not only continue to explore once cash flow is generated, but also continue to explore once the construction starts. In 19 months of construction, you can add some sizable ounces to this resource reserve. But clearly, we would always put aside money to continue to explore the potential of this property. So I guess a rule of thumb for me is that if you're taking 100,000 ounces out and you have upside potential, you should be at least replacing 100,000 ounces every year, and that just extends your mine life. But obviously, if you want to drill more, then you could look at increasing that to a phase 2 or a larger size plant. Are the board members believing and supporting the company by buying the shares? Absolutely. We've all participated in every single private placement raise. So we have put our own money into this company. We're fully behind it and we fully believe in it. We also see the upside potential, not just in the share price, but also on obviously bringing this project into construction, and obviously on the resources and the reserves as well. And then I have one last question that's just come through now. What is your social impact in Mali? How many jobs do you create during this construction phase? How many jobs after ramp up? Look, I think off the top of my head, right now we have a very defined policy in employing locally where we can. So on most of the jobs that we're doing now, we can employ from the local villages. So we are creating immediate wealth coming into the communities. I'm very passionate about making sure that the local communities are looked after. As wealth comes in and the communities improve and carry out their own social projects that we can assist with, that means that obviously the whole region is brought up in terms of wealth and good standing. On top of that, then I guess during the construction phase, there will probably be in excess of 1,000 people that are required for the 19 months. Not all at the same time, but on and off. And most of those will be situated in one of the camps that we've designed. And then after ramp up, I guess it's not a big mine, so probably in the region of 200 or 300 full-time jobs as the mine gets to steady state. So certainly, in terms of the local communities where there is very little formal employment, it is very good for the local communities. Where we can, we will upskill and use local labour. Obviously, some of those people will have to come from further afield in Mali and West Africa as well. But ultimately, we see this as a long-term project that will be in this community for many, many years. And it makes a whole lot of sense to employ locally where you can. I'll just see if any more questions are coming in. Any more side credits from silver or copper? I wish. Unfortunately, this is pretty much a pure gold play. There is little bits of silver in there, but nothing that's really worth going through the process of taking out. Any plan B in case you can't raise the money for the 100,000 ounces, staged ramp up, etc.? Absolutely. We've had a look at every single option here. We have had a look at a possible sort of phase 1, phase 2. We've done it very successfully in other companies that I've worked for, where you effectively build it as a modular plant. So you leave the space for the next phases, and that doesn't disrupt production. So that is definitely something that could be done. Unfortunately, when you do these things in phases, some of the infrastructure costs have to be done up front. So typically what you would see is a stage one of 50,000 ounces would probably cost 70% of putting in a 100,000 ounce stage all at the same time. And then one last question that I'm seeing here. What are your targets for the next 3 months or 6 months? I think that's a good question. For us, it's very clear. We would like to now consolidate all of the drilling results that we've received in, which will gravitate towards us updating the resources and the technical report. Hopefully what that will see is an extended mine life. It will also see additional ounces at the back end of our current mine profile. And hopefully it will also see an improved economics on that as well. At the same time, the sulfide test work will be wrapped up over the next month, and all of that will roll up into this updated technical report as well. As I mentioned, we are hoping to be able to bring between 100 and 150,000 ounces of sulfides into our reserves as we pull that in. So I think we've got a very busy 3 to 6 months. We're going into the rainy season now, so there's not a lot we can do on the drilling side, but we are preparing to start to drill again after the rains finish. I guess I'm going to get it down to 2 more questions now. Are there any other mines using gravity plus CIL to process sulfide ores in West Africa? I'm not 100% sure. There are, but some of it has to be floated first. So typically what you would see on some sulfide ores is crushing and milling up front, flotation to produce a concentrate, which then goes through the gravity plus CIL process. We just have this amazing sulfide that doesn't need to be concentrated before it goes through the gravity plus CIL process. So therefore, the only possible changes to our process plant to treat sulfides will be a little bit of the upfront milling, and that's very straightforward. How many meters of drilling have you planned for the next 18 to 24 months to get to 1.3 to 1.5 million ounces? It's around about 15 to 18,000 meters, so very similar to what we've already done in the last 19 months. Clearly, that's very funding dependent, so we don't have that money in the bank right now to be able to commit to that. But we believe that with around about 15 to 20,000 additional meters, we should start to see reserves jumping up to that 1.3 to 1.5 million ounce number. So hopefully I've answered most of the questions that have come through. I hope that the update's been very useful to you. As you can see, Daniel's, our VP Corporate Affairs name and number is on this website, but I'm also on the website as well. Please feel free to get in touch with us outside of this. We will make this presentation available. We try and make them detailed enough that as a standalone presentation, they can, you can go through them outside of these meetings. And we look forward to the next webinar update. So with that, I'd like to wish you all good evening if you're in Europe or Africa, and enjoy the rest of your afternoon in North America, Canada. Thank you very much.